Okay, let's dive in. Something massive is happening right now. It's not just a shift, it feels more like a fundamental rebuild of the global financial system. And this change, it's set to redefine the US dollar, impact your wealth, your family's wealth for generations, and really alter the entire monetary structure as we know it.
It's a critical time, absolutely. And right at the heart of it all is this fascinating paradox involving stablecoins. I mean, these were supposed to be the path to decentralized finance, right?
Yeah.
The less volatile crypto operating outside the old fiat system.
Yeah, the whole idea was freedom from banks, freedom from government control, basically. But somehow they've ended up deeply, deeply integrated. They're now a crucial pillar propping up the US dollar and helping manage this absolutely enormous mountain of US debt. We're talking nearly $38 trillion now.
Staggering.
So our mission today in this deep dive is pretty ambitious. We want to unpack the source material that lays out the US strategy, this regulatory framework people are calling the Genius Act. We'll also look at the geopolitical pushback, specifically Russia's very public accusation of a potential global rug pull.
A serious charge.
Definitely. And finally, we need to explore the game theory behind it all. How this whole situation, this kind of geopolitical chess match, might accidentally turn stablecoins into a Trojan horse, accelerating mass Bitcoin adoption.
That's the perfect way to frame it. It's essential we dig into this because the stakes are just incredibly high. So maybe just to quickly set the stage. Stablecoins, traditionally, digital assets pegged one-to-one to something like the dollar, designed for speed, low fees, bypassing the old banking system.
Right, the basics.
But their sheer scale and how fast they've been integrated, that's fundamentally changed their role. Instead of disrupting the system from the outside, they're being pulled right into the center, almost co-opted to support it.
And the issuers themselves are making some pretty wild claims, aren't they?
They really are. Tether, which is the biggest player by far, made this incredibly bold prediction recently. They said that within 5 years, all major fiat currencies, dollar, euro, yen, you name it, will basically cease to exist as we know them today.
Cease to exist. That's strong.
Yeah, replaced entirely, they claim, by tokenized, digital, programmable stablecoin versions.
Wow. So the very company dominating the dollar stablecoin market is predicting the end of the dollar in its current form. What does that actually imply for, the future of money?
Well, it implies a massive shift towards control and surveillance. We're moving from the, let's say, analog dollar, which had its issues but also pockets of anonymity, to something digital, fully trackable, programmable. And the sources really highlight this, that this new money is increasingly controlled not by public bodies, but by private corporations.
That sounds potentially problematic.
It is. Okay, let's unpack this. Because this whole transition, it's not happening in a vacuum. It seems to be driven by a kind of systemic necessity. The U.S. government's struggle to manage that exploding debt load without finding new, reliable buyers for its treasuries.
Right, the debt. That really seems to be the root cause driving all this financial reengineering. The dollar's dominance, 80 years as the global reserve, that gave the U.S. immense power. But that foundation, the sources are clear, it's cracking, mostly just because of the sheer scale of the numbers involved.
Exactly, nearly $38 trillion in debt. The interest payments alone are becoming, one of the biggest items in the federal budget. It's just not sustainable long-term without constant, massive refinancing.
And that's where the risk comes in, right? Because who's buying all this debt?
Precisely. That's the critical vulnerability. For decades, the U.S. could rely on foreign nations, think China, Japan, oil exporters, to soak up trillions in U.S. treasuries. That kept the system afloat. But that demand? It's significantly weakened. They're not buying at the same levels. So without that constant inflow, the U.S. urgently needed a new source of demand. An instant, reliable, almost automatic buyer.
And conveniently, regulation provided one under the guise of, consumer protection.
Exactly. Earlier this year, the first major federal crypto law gets signed. The sources we're looking at, they colloquially call it the Genius Act. And the nickname isn't really about protecting consumers. It reflects the analysis that its true genius is fiscal engineering. The core mandate is simple. All U.S. dollar stablecoins must be backed one-to-one.
Not just by dollars in a bank, though.
No, that's the key. Backed by U.S. dollars or short-term U.S. Treasury.
Okay. And that's where it gets really interesting.
Bingo. That single requirement created an immediate global demand source for U.S. debt. Every time an issuer like Circle or Tether creates a USDC or a USDT, they have to buy treasuries. So think about it. Every time someone anywhere in the world uses a dollar stablecoin, maybe for trading, maybe for remittances, they are indirectly automatically forcing the purchase of U.S. government debt.
It turns millions of global users into involuntary lenders to the U.S. government.
That's exactly it. Even folks who are traditionally skeptical of crypto, like Cornell professor Dave Collum mentioned in the sources, they admit the reason politicians suddenly got friendly with digital assets is pretty straightforward. It's because stablecoin issuers are now mandated buyers of short-term treasuries. Even the critics see the primary function here is debt absorption. It's a way to create demand that, frankly, Congress probably couldn't achieve through normal budget processes.
And the U.S. benefits because stablecoins are just better infrastructure for the dollar in many ways. Faster, cheaper.
Much faster, yeah. Transaction fees are tiny compared to traditional wires, and the accessibility is huge. Traditional digital dollars, like through banks, often have restrictions, high fees, slow settlement. Stablecoins bypass a lot of that.
You see this playing out globally, right? In places where getting actual U.S. dollars is tough.
Absolutely. Think Nigeria, dealing with constant devaluation, or Argentina facing hyperinflation. People there are using stablecoins for daily needs, for savings, for sending money. It's becoming essential infrastructure.
And because of that global utility, something like 99% of all stablecoin demand is for U.S. dollar stablecoins.
Right, and that's the cumulative effect, the kind of unintentional brilliance for the U.S. strategy. These global users just want financial stability or better transaction rails. But their combined actions create this massive, constantly growing global demand for U.S. government debt. The sources project that if this keeps up, stablecoin volume could actually outpace traditional fiat volume like credit cards within just a few years.
So the U.S. found a way to export its currency more efficiently and finance its debt simultaneously. That's quite the maneuver.
It is. But this strategy, however clever economically, hasn't gone unnoticed by global competitors. And it's definitely stirring up geopolitical tensions.
Which brings us to the Russian accusation.
Yes, we have to report this impartially, of course, but it's a significant warning. Just last month, Anton Kobakov, who's a top economic advisor to President Putin, he went public. He accused the U.S. of preparing, his words, a global rug pull targeting anyone holding dollar assets, especially these stablecoins.
A rug pull? How would that even work with stablecoins? They're pegged one-to-one.
Well, the alleged plan Kobakov outlined is this. First, the U.S. encourages massive global adoption of dollar stablecoins, get billions of people reliant on them. Then, once usage is deeply embedded globally, the U.S. could unilaterally devalue the peg. So instead of one stablecoin equals $1 US, maybe it becomes one stablecoin equals 50 cents or 20 cents or whatever they decide.
Just change the rules overnight.
That's the accusation. The effect would be catastrophic for anyone holding those stablecoins or even regular dollars or dollar assets outside the U.S. Their value gets slashed. But for the U.S., it would instantly boost their balance sheet relative to their debt, effectively reducing the real value of the debt they owe. It's making the rest of the world pay off U.S. fiscal imbalances.
That sounds like something out of a dystopian novel. Could a government actually do that? Just unilaterally devalue like that?
Well, history gives us a very clear precedent right here in the U.S. The parallel to 1933 is striking.
You're talking about Roosevelt and gold confiscation.
Exactly. Executive Order 6102. The U.S. government required citizens to turn in their gold bullion. It wasn't optional. Collectible coins were exempt, but your investment gold, hand it over.
And then the government just revalued it.
Immediately. Before the order, gold was valued at $20.67 an ounce against the dollar. After they collected it, they instantly reset the price to $35 an ounce. Overnight, the value of the gold held by the U.S. government, its reserves, its balance sheet, jumped by nearly 70%.
But what about the average person holding dollars?
Their purchasing power collapsed. If you held dollars in the bank, they suddenly bought almost 70% less gold. Your wealth was effectively confiscated through devaluation. So the technology is different now, digital stablecoins instead of physical gold bars, but the alleged scheme. Using unilateral revaluation to wipe out debt and transfer wealth to the state, the playbook looks disturbingly similar.
Okay, that historical context is chilling. And it connects to another risk factor the sources raise, the role of private corporations.
Yes, this is crucial. Who actually issues these stablecoins? It's private companies like Tether and Circle. They are now essentially the issuers of the currency intended to replace the dollar, and through the Genius Act, they are the primary buyers propping up U.S. government debt.
So private companies control the currency and hold the government's debt. That seems like an enormous concentration of power.
It is. The sources use terms like dystopian control. Think about it. If a few private profit-driven companies effectively own the nation's debt and control the future money supply, where does public accountability go?
But wait, isn't the Federal Reserve already kind of a murky, quasi-private entity controlling our money? How is this fundamentally different or worse?
That's a fair point.
Oh,
The Fed is opaque. But theoretically, it has a public charter, some congressional oversight, a mandate beyond pure profit. Private companies like Tether, their primary driver is profit, shareholder value. And the speed is different. If a major stablecoin issuer fails due to a hack, mismanagement, loss of confidence, the contagion is instant and global because of the technology, much faster, potentially much more damaging than a traditional bank run.
we saw a glimpse of that with Terra Luna collapsing in 2022, right? That was like a digital bank run on a stablecoin.
Exactly. It showed the inherent fragility. Trust in the backing is everything. And if that backing is U.S. Treasuries and confidence in those waivers, the whole thing can unravel incredibly fast.
Which leads to this ultimate irony about Tether, the biggest issuer.
Right. While they're out there promoting their U.S. dollar stablecoin as the future, what are they doing with their own reserves?
They're buying gold, lots of it.
Billions in physical gold. Not just paper claims, but actual tangible gold. They're even investing directly in gold mining companies. They are actively hedging against the very asset, the U.S. dollar, that their main product relies on. They're preparing for a scenario where the dollar isn't the center anymore, positioning themselves for that inevitable currency reset. They see central banks doing the same thing, buying gold like never before.
So even the biggest promoters of the digital dollar are betting against it long term. Okay, so that sets up this fascinating game theory aspect. How does all this maneuvering accidentally pave the way for Bitcoin?
This is where it gets really interesting. Moving beyond the immediate geopolitics to the underlying economic incentives. The sources, especially analysis from researchers like Eric Yakes, argue that stablecoins are effectively building a new parallel banking system.
How so? By cutting out the old banks.
Exactly. Traditionally, commercial banks act as intermediaries, taking deposits and buying government debt. Stablecoin issuers bypass that. They take in dollars or equivalents, buy government debt directly, and then issue a token representing that claim. They're cutting out both the central banks and the commercial banks from their traditional roles in money creation and debt financing.
But the U.S. regulation, the Genius Act, tries to limit that, right, to protect the existing banks.
Precisely. Yakes argues the Genius Act is essentially a regulatory carve-out designed to shield the incumbent banking system. Remember those two key restrictions. U.S. stablecoin issuers cannot pay interest to holders, and they must hold mostly short-term government debt. This ensures traditional banks, which can offer interest-bearing tokenized deposits, still have an advantage. It stops stablecoins from becoming direct competitors for regular bank accounts.
Okay, so the U.S. tries to keep stablecoins in a specific box to help manage debt, but prevent them from disrupting banks too much.
Right. But here's the flaw in that plan, driven by the free market. Those restrictions, no interest, limited reserves make U.S. regulated stablecoins, well, frankly, less sexy to the global market.
Especially for people outside the U.S. who are looking for yield, not just a transaction tool.
Exactly. If you're in Argentina or Nigeria, you don't just want a digital dollar. You want a digital dollar that earns something, that preserves capital or offers a return. So the unintended consequence of the U.S. trying to protect its banks is the guaranteed emergence of a massive offshore stablecoin market, one that operates outside U.S. rules.
And the big advantage of that offshore market?
Simple. They will pay interest. And they won't be restricted to only holding short-term U.S. treasuries. They can hold whatever reserves the market deems best, whatever allows them to offer the most competitive yield.
Because at the end of the day, in this new digital fiat game, yield is king. Everyone wants the best return.
That's the driving force. And this competition for yield leads directly to the end game. How do you pay the best interest rate? You have to hold the best performing reserve assets, assets that appreciate safely and reliably.
So what's the best reserve asset likely to be in that competitive environment?
Bitcoin.
Right, because unlike fiat debt instruments, it has that potential for significant appreciation and finite scarcity.
Exactly. Look at Tether again. They already hold about 5% of their reserves in Bitcoin. Right now, they don't need to pay much interest to dominate, so it's just extra profit for them. But imagine a truly competitive offshore market where multiple stablecoins are fighting for users based on the interest they pay. That 5% Bitcoin allocation suddenly becomes their killer app. The issuer holding the most appreciating sound reserve asset can offer the best yield.
So the competition itself forces issuers to hold more Bitcoin.
It compels them to. This is the Trojan horse scenario in full effect. Stablecoins are doing two things simultaneously. First, They're onboarding billions of people globally onto crypto infrastructure, using wallets, keys, understanding digital assets. They're teaching the world the mechanics needed for Bitcoin without people even realizing it.
Training wheels for Bitcoin, basically.
Kind of, yeah. And second, the reserve competition becomes an inescapable vortex pulling capital towards Bitcoin. As issuers compete on yield, they'll be forced to adopt a strategy like Michael Saylor's, hold increasingly large amounts of Bitcoin in reserve. That 5% Bitcoin reserve might become 10%, then 20%, maybe 50% or more, just to stay competitive on the interest rate they can offer holders.
And what does that constant competitive buying pressure do to Bitcoin?
It creates a massive structural global demand. The market cap explodes maybe $20 trillion, $30 trillion, who knows? As the market cap grows, the volatility naturally dampens. Bitcoin matures into a truly global reserve asset.
And at that point?
At that point, everyone looks around and says, wait a second, why are we bothering with these stablecoins? They have counterparty risk, they're run by private companies, they rely on holding the right reserve. Why don't we just cut out the middleman and use the actual reserve asset directly?
So people just start transacting directly in Bitcoin, skipping the stablecoin layer altogether?
That's the logical final stage. The very mechanism the U.S. is using to manage its debt, the thing Russia's warning about, it ironically forces the world onto infrastructure compatible with Bitcoin and creates market incentives that drive capital into Bitcoin as the preferred reserve. It massively accelerates global adoption.
The law of unintended consequences in full force. Okay, let's bring this back to the present. How are the current market signals reflecting this underlying tension and potential shift?
Well, the recent market action has been really telling, actually. We saw some significant selling pressure just recently.
Yeah, the sources mentioned whale activity, large holders selling off.
That's right. Over $12.7 billion worth of Bitcoin sold off by these large entities in just the last 30 days. That's apparently the biggest wave of whale selling since the depths of the 2022 bear market.
Normally, that kind of selling would tank the price, wouldn't it?
In previous cycles, absolutely. It would have likely caused a major crash. But here's the critical point. Despite that huge supply hitting the market, the price held remarkably firm, staying above that $110,000 level mentioned in the analysis.
Wow. What does that resilience tell us?
It tells us there's incredibly strong underlying demand, likely from institutional buyers continuously accumulating, possibly through the ETFs. They're basically absorbing massive sell-offs. The sources call it insane resilience, and it points to a much more mature, institutionally backed market than we've seen before.
And meanwhile, looking ahead, the macro environment seems poised to shift too, liquidity coming back.
All signals point that way. Morgan Stanley, for example, is projecting interest rate cuts basically every quarter, right through 2026. That's a huge signal that the era of tightening financial conditions is likely over. And liquidity is set to return to the system, probably, as the source puts it, with a vengeance. And that's typically very bullish for hard assets like Bitcoin and gold.
Speaking of gold,
Yeah,
it's been on quite a run itself.
it really has. Setting new all-time highs almost daily. There's not just noise, it's a powerful signal. It shows that big money central banks, institutions, wealthy individuals is losing faith in the traditional debt-based inflationary fiat system represented by the dollar. They're seeking refuge in hard assets.
And Bitcoiners tend to cheer for gold's rise, right? Even though they're sometimes seen as competitors.
Yeah, because it validates the core thesis. The fiat system is breaking, and people are moving to stores of value. The higher gold's market cap goes, the bigger the overall pie for sound money becomes. And given Bitcoin's advantages, portability, divisibility, verifiability, absolute scarcity, every dollar that flows into gold arguably raises the potential ceiling for where Bitcoin can eventually go. Gold is expanding the market that Bitcoin aims to capture.
So when you compare Bitcoin not to the dollar but to gold itself, what does the analysis show?
The technical analysis highlighted in the sources suggests Bitcoin is on the verge of breaking out of a massive 5-year consolidation pattern when priced in gold. Historically, breakouts from patterns this large have led to very significant moves. The analysis mentions potentially 300% rallies, targeting price levels like $167,000 to $185,000 in the relatively near term, maybe the coming months.
So the takeaway isn't just Bitcoin might go up, it's bigger than that.
Much bigger. The core context is that the dollar itself is actively breaking down. The foundation is eroding. The Genius Act, the stablecoin strategy, these are clever patches maybe, temporary fixes driven by geopolitical necessity and debt management. But they don't fix the underlying solvency problem of the fiat system.
And the game theory seems settled, at least according to this analysis. The US and Russia might be fighting over stablecoins, but Bitcoin is positioned as the ultimate neutral settlement layer, the non-sovereign reserve asset that wins in the end.
That's the long-term thesis presented.
Okay, let's try to wrap this up. We've covered a lot of ground in this deep dive. We saw how the Genius Act created this instant demand for U.S. debt using stablecoins, essentially a short-term fix. That move triggered geopolitical warnings, like Russia's rug pull accusation, and raised serious questions about the risks of private corporations gaining immense control over money and debt.
But then we saw how the free market, driven by the relentless search for yield, likely hijacks this entire setup. The competition forces stablecoin reserves towards the best-performing asset Bitcoin, turning stablecoins into this unwitting Trojan horse that accelerates global Bitcoin adoption.
Right. So stablecoins buy the government some time, maybe kick the can down the road on the debt issue.
They can't fundamentally change the rules of money. In a competitive market, sound money tends to win. The long-term game theory seems pretty clear from this perspective.
Which leaves us with a final thought for everyone listening.
Yeah, a provocative question, perhaps. If the ultimate destination of this monetary transition appears to be Bitcoin, driven by these powerful market forces, and we know from history that currency resets often involve massive, sudden wealth transfers, how much of this end game, this long-term game theory, do you think the governments, the central banks, the established players truly understand right now? And how quickly might they be forced to adapt their reserves, maybe adding Bitcoin themselves, just to keep up? And more importantly, considering these systemic risks and the potential for a major reset, what specific actions are you taking today to position your own generational wealth? History suggests the window for proactive preparation doesn't stay open forever.
A lot to think about there. Thank you for joining us for this deep dive into the complex world of stablecoins, debt, and the future of money. We'll see you next time.
Okay, so something huge is shifting under our feet in the global financial system. Really tectonic stuff.
There really is.
We're talking about changes that could reshape the dollar, yeah, but also our own wealth, the whole monetary setup we've known. And today, we're not just hitting, the usual Bitcoin volatility chat. We're zeroing in on stablecoins.
The supposedly boring one.
Exactly, the stable crypto.
Yeah.
But what we're finding is they're tied into this massive $38 trillion U.S. debt situation.
And the fact that the U.S. government desperately needs anyone to buy its bonds.
Which could all be leading to a pretty aggressive monetary reset.
Yeah, this deep dive feels critical right now because stablecoins, they started out as this decentralized dream, right? Financial freedom, access for everyone.
The bridge to crypto, basically.
Precisely. Getting people onto those cryptographic rails, but now the sources we're looking at show they're being pulled right into the heart of the system they were meant to disrupt.
Serving as a lifeline for the U.S. dollar structure itself.
Yeah. And just for anyone listening who might be newer to this, a stablecoin is pretty simple in concept. It's a digital token pegged one-to-one to something else.
Usually the U.S. dollar, almost always. Sometimes gold, maybe other things, but mostly dollars.
Right. The idea is you get the speed and borderless nature of crypto, but without the wild price swings, supposedly.
But the tension here is just fascinating. They're meant to be global, permissionless, a way to transact or seize outside the old banking system, No slow transfers, no central bank oversight, ideally.
But the data, the reality, shows they're moving closer and closer to the core of global finance. They're providing this really necessary mechanism to prop up U.S. government debt.
So this clash between corporate control and that original decentralized idea, that's really what we need to unpack today.
Absolutely. Our mission here, as we get into these sources, is kind of threefold. First, we got to understand the sheer fiscal need that pushed the U.S. towards this digital fix. Why now? Second, we need to look hard at the systemic risks. What happens when huge private companies are basically running the digital version of the world's reserve currency?
Right, the concentration of power.
Exactly. And third, we're going to draw some, frankly, chilling historical parallels. We'll look back at past currency revaluations, specifically the U.S. in 1933.
And see where real debasement-proof assets like gold and Bitcoin fit into this whole high-stakes game.
Okay, let's unpack this. Let's start with the immediate crisis the U.S. is facing, because you can't understand the stablecoin piece without understanding the pressure cooker environment it emerged in.
So the U.S. dollar, it's been king for, 80 years?
Yeah.
Since Bretton Woods. It's the bedrock of global trade, especially with the petrodollar system.
It has been, but that bedrock is showing some serious cracks. You can see it in two huge related numbers.
The debt first.
Yeah, U.S. national debt is pushing $38 trillion. Just a mind-boggling number.
And the second number.
The cost of servicing that debt, the interest payments, they're becoming structurally unsustainable. They're now competing with or even beating huge budget items like defense spending. And for decades, foreign countries think China, Russia, other big players, they were happy to buy U.S. treasuries. They'd recycle their trade dollars into U.S. debt.
Standard operating procedure.
Right. But that demand, it's drying up fast. Geopolitics, countries looking for dollar alternatives. The appetite just isn't there like it used to be.
Okay, so if foreign buyers walk away, who buys all that debt? The U.S. government needs to borrow constantly to function.
Exactly. Without that steady demand for treasuries, the whole Asian sputters. The U.S. urgently needed a new buyer, a big buyer, maybe one that wasn't too sensitive about the price.
And they needed them now to soak up potentially trillions in treasuries being sold off.
Which brings us to the timing and this kind of strategic regulatory push. Let's call it the Genius Act for simplicity.
The Genius Act.
Yeah.
Okay. What does it do?
Well, the timing is key. This refers to the overall regulatory effort, like some of the ideas in the Stable Act proposals. They aim to create a controlled framework for stablecoins.
And the crucial detail.
The mandate, the absolute core of it is this. Major U.S. dollar stablecoins must be backed one-to-one, either by actual U.S. dollars in a bank or, much more strategically,
U.S. treasuries.
U.S. treasuries, exactly. Short-term ones, mostly.
Now, on the surface, this sounds reasonable, right? Consumer protection. Make sure these digital dollars are actually backed. Prevent another Terra Luna-style collapse.
That's the official line, and there's some truth to it. But the analysis in our sources digs deeper. It reveals this incredibly strategic, mechanical function that directly addresses the debt crisis.
It's an economic lifeline for the U.S. government, isn't it? Right. Beyond just protecting consumers.
It absolutely is. It served as an instant, powerful stopgap for that collapsing foreign demand for U.S. debt. Let's get really mechanical here for a second. Every single stablecoin that gets issued and circulates forces the company issuing it, Tether, Circle, whoever, to buy an equivalent amount of U.S. debt, usually short-term T-bills.
So it automatically creates this huge, new, mandated pool of buyers for U.S. government debt.
Instantly. We're talking hundreds of billions of dollars already held by these issuers, and it's growing constantly.
It's like exporting the debt problem. The U.S. found a way to make private companies absorb its funding needs, making the debt someone else's problem.
And it's kind of brilliant in a way. The government doesn't have to do as much inflationary quantitative easing, printing money to buy its own debt because the stablecoin issuers are effectively doing it for them.
Wow. Okay. So where does the global use fit in? Who's actually using all these stablecoins?
Well, that's the other key part. Right now, something like 99% of all stablecoin demand globally is for U.S. dollar stablecoins.
And what are people doing with them?
Primarily crypto trading, DeFi stuff.
Yeah.
But increasingly, it's merchant payments, remittances, cross-border transfers.
And it's not just like tech bros in Silicon Valley using them.
Not at all. The appeal is global. They're faster than traditional bank transfers, the fees are often lower, and this is crucial. They give people access to dollars in countries where it's normally really hard, expensive, or politically risky to get them.
So places like Nigeria, Argentina, Turkey, people trying to escape hyperinflation or just send money home.
Exactly. People are adopting them because they solve real financial problems. They're just a better tool for many people's needs.
But the unintended consequence, or maybe intended.
Well, yeah. The consequence is that all this grassroots global adoption inadvertently props up the U.S. debt market. Every Tether or USDC bought in Buenos Aires or Lagos ultimately forces the issuer to buy more U.S. treasuries.
The faster the world adopts stablecoins, the easier it is for the U.S. to fund its deficits. It maintains this illusion of stability.
And the growth curve here is steep. The sources suggest that if this keeps up, stablecoin transaction volume could actually outpace traditional fiat currency volume in just a couple of years.
We're basically watching the dollar get replaced by its tokenized twin in real time.
It looks that way.
Which brings us right to the control issue. If stablecoins are potentially replacing fiat for global transactions, who's actually pulling the strings? We shift from the debt risk to the control risk.
Yeah, and Tether, the biggest stablecoin issuer out there, they made this incredibly bold prediction recently, almost jarring.
What did they say?
They claimed that within the next 5 years, all major fiat currencies, dollar, euro, yen, the lot will basically only exist as stablecoins. Fiat, as we know it, will be gone.
Hold on. So bank account balances, physical cash. They think that's all going away, replaced by tokens.
That's the assertion. Replaced by a tokenized version running on some kind of blockchain, public or maybe semi-private.
Okay, we need to be super clear here. This is not Bitcoin taking over the dollar.
Absolutely not. This is a digital tokenized dollar. It's programmable. It's potentially highly trackable.
And crucially, it's not a CBDC, right?
Yeah.
Not a central bank digital currency run by the government.
Precisely. That's a key distinction. A CBDC is state surveillance, state control over the ledger.
Whereas this model,
This is corporate surveillance and control. It's issued by private companies like Tether, like Circle. They operate on a public blockchain, yes, but they hold certain keys.
which raises huge questions about who has the power and the systemic risk. What kind of control are we talking about?
Well, let's talk about surveillance first. With a CBDC, the government sees everything, can freeze anything directly. With a private stablecoin, the corporations control critical functions, specifically tools like asset blacklisting and whitelisting.
Blacklisting. What does that mean in practice? Can they just shut off someone's money?
They already can, technically. Companies like Circle and Tether have the ability, if they get a legal order or suspect crime, to freeze the funds in a specific crypto wallet address.
How?
They just blacklist that address in the smart contract. The stablecoins in that wallet become unusable, can't be spent, can't be transferred, frozen solid.
So if most global trade moves onto tokens issued by, say, 2 or 3 big companies,
Those companies become the effective gatekeepers. They hold the technical power to cut off your access to your digital dollars.
that's alarming. We trade the decentralized dream for a corporate choke point.
Pretty much. And underneath all this tech innovation, the fundamental risk hasn't gone away. The whole system stability still rests on the thing backing it,
U.S. Treasuries.
U.S. Treasury. So if confidence in U.S. debt ever really breaks, and given the deficits and geopolitics, that's not unthinkable. These stablecoin dollars could just evaporate
Look,
or lose their peg dramatically.
we saw a preview of this kind of fragility in crypto already, didn't we?
We did. The 2022 collapse of Terra and Luna. Now, they were different. They were algorithmic stablecoins relying on code, not reserves.
Right.
But when market confidence broke, it was like a digital bank run. Total devastation in days. With Tether and Circle, they are backed by assets, but the risk just shifts. It shifts to the quality and stability of those assets.
U.S. government debt.
Exactly. The system isn't inherently safer. It's just bigger, faster, and plugged directly into the sovereign debt of a nation swimming in it.
So the moral questions, the power concerns that really come together here. We could be heading towards a reality where private companies are mandated to prop up U.S. debt while simultaneously controlling the world's access to its own digital currency through things like blacklisting.
It's a massive step away from even the current system. It could genuinely lead towards a kind of dystopian control. If private firms own your country's debt and control the digital money you use, that's an incredible, potentially unchecked concentration of power.
Financial censorship becomes a corporate decision.
Potentially. And the people running these systems, the gatekeepers of the new global dollar, they aren't elected officials accountable to the public, they're CEOs.
Okay, so if private companies control the rails and the U.S. government is backing those rails with its debt, what stops the U.S. from just changing the rules when that debt becomes completely overwhelming?
And that leads us straight into some really stark accusations being thrown around on the world stage. The threat of revaluation.
You mean like the government just deciding a dollar isn't worth a dollar anymore?
Essentially, yes. This connects to what Vladimir Putin's special advisor, Anton Kobikov, accused the U.S. of planning. He used inflammatory language, calling it a potential global rug pull.
A rug pull, like pulling the rug out from under everyone holding dollars.
His accusation was that the U.S. is using stablecoins to set the stage for a soft default on its massive debt, which was around $35 trillion at the time he said it. Now, forget the rhetoric for a second.
Look at the mechanism.
Look at the mechanism being suggested. It's actually got historical precedent.
Yeah.
The idea is wait until stablecoins are everywhere. Billions of people, businesses worldwide, using these tokenized dollars for almost everything.
Global adoption is key.
Absolutely. Once that happens, the theory goes, the U.S., facing a fiscal cliff, could just change the peg. Through regulation, maybe an executive order. They could say, okay, that 1.1 peg, it's now 1.0.50. Your digital dollar is now only worth 50 cents of whatever the new revalued dollar unit is, or maybe even less.
And the impact of that.
Instantaneously, the U.S. government's balance sheet looks way better. They've effectively erased half their debt burden overnight, denominated in the old dollars.
So the federal debt gets slashed. Maybe the U.S. credit rating technically stays okay because it wasn't a hard default.
That's the idea behind a soft default. You don't refuse to pay, you just pay back in currency that's worth a lot less.
But who eats the loss? Who pays for that debt reduction?
Everyone else. Every single person, company, central bank holding those stablecoins or any dollar assets anywhere in the world, they pay the price. Their savings, their reserves get devalued massively, maybe overnight.
It's a massive transfer of wealth from global dollar holders straight back to the U.S. Treasury.
Exactly. It allows the U.S. to externalize its debt bomb onto the rest of the world.
Okay, but I have to push back a bit here. Wouldn't that completely destroy trust in the U.S.? Wouldn't the dollar instantly lose its global reserve status? Why would they risk blowing up global trade like that just for a short-term debt fix?
It's a huge gamble, no question. The risk is astronomical. But the argument for it, from a desperate government's perspective, is one of necessity.
What do you mean?
When the interest on $38 trillion, maybe $40 trillion by then, is eating up almost all your tax revenue, your options get pretty extreme.
It's choose your poison time.
Right. Is it total sovereign collapse, a hard default? Or is it this controlled demolition, a soft default via revaluation? They might choose the latter, arguing it's the lesser of two evils.
And having stablecoins as the main rails makes that easier to execute.
Potentially, yes. It gives them a direct lever on the digital currency system, maybe making it cleaner than trying to manage a default across physical cash, bank deposits, and digital tokens simultaneously.
What's really wild is that this isn't some sci-fi scenario. The sources point directly back to U.S. history. The playbook exists.
It does. We just need to look at 1933.
FDR.
President Franklin D. Roosevelt, Executive Order 6102. It basically forced Americans to turn in their gold bullion to the Federal Reserve.
Confiscation.
Effectively, yes. Though, interestingly, rare and collectible coins were exempt. They were targeting the monetary gold the savings people held.
Okay, so they gather up the gold, then what?
Then they pulled the revaluation lever instantly. Gold went from being officially priced at $20.67 an ounce to $35 an ounce overnight.
And the effect on the government's books.
Massive boost. All that gold the government now held was suddenly worth way more. It propped up the balance sheet, gave them breathing room during the Depression.
But the people who turned in their golds or just held dollars, what happened to their wealth?
Crushed. If you held dollars, your purchasing power relative to gold dropped by about 70%. Overnight, your savings were just devalued by government decree.
Wow, so an entire generation basically lost a huge chunk of their wealth.
By executive order. The parallel to a potential stablecoin revaluation is chilling because the mechanism is the same. Reduce the government's debt burden by changing the value of the currency everyone holds.
So the sobering question for you listening is pretty stark. Could you handle losing half, maybe more, of your savings, your retirement fund, just wiped out because the government decided to revalue the digital dollars you hold?
History shows it's not theoretical. It's a tool governments have used. And stablecoins. They might just be the perfect, fast-acting digital version of that tool for the 21st century.
That danger, that potential for a soft default using digital dollars makes this next part almost ironic, doesn't it?
Deeply ironic. We need to look at what the stablecoin issuers themselves are doing with their own money, their reserves.
Right. The very companies pushing this all-digital dollar-pegged future, a future totally reliant on U.S. debt stability, what are they buying?
They're buying the one asset that screams, I don't trust the long-term value of the dollar or U.S. debt. They're buying physical gold.
Tether, specifically.
Tether, yes. Biggest player. They hold billions of dollars worth of physical gold bullion in their reserves. They explicitly label it as a hedge against fiat instability.
And it's not just buying gold bars, is it?
No, the sources say they're going further. They're investing in gold mining companies, securing royalties. They're locking in a future supply. They clearly see gold playing a major role going forward.
So they're hedging their own business against the failure of the very asset, the U.S. dollar via treasuries, that they are required to hold and promote globally.
It's the ultimate do as I say, not as I do. They're positioning themselves for the monetary reset they see coming, and they're not alone.
Who else is doing this?
Central banks. Globally, central banks are buying gold at rates not seen in modern history. Record purchases year after year.
Why are they doing that? Nostalgia.
Hardly. They're positioning for a world where the US dollar isn't the only game in town. They're building reserves that are independent of US political decisions or financial stability. Gold is that neutral settlement asset, outside the control of any single nation.
So Tether is basically acting like a central bank in that respect, hedging its dollar exposure.
Precisely. Their core business, managing the world's digital dollar supply via stablecoins, is massively exposed to the risk of US debt collapsing or being devalued. Gold is their insurance policy against the very system they're currently helping to prop up.
And we see gold's price reflecting this concern, right? It keeps hitting new all-time highs, blowing past $2,300, $2,400. What's that signal?
When gold surges like that, especially when consumer price inflation isn't necessarily exploding at the same rate, it's a flight to safety, a flight to hard, tangible assets you can trust.
It means loss of faith.
It signals that sophisticated money central banks, large institutions, maybe even stablecoin issuers themselves, is losing faith in the long-term viability of the current debt-based inflationary system. Gold is liquidity, it's final settlement, and it's outside the traditional banking structure.
Okay, so how does Bitcoin fit into this? Gold is rising, signaling distrust. Why do Bitcoiners often seem happy about that? Aren't they competitors?
It's less competition, more like sequencing. Bitcoiners generally see gold's rise as a positive sign.
Why?
Because it validates the whole thesis of needing non-state hard money. Gold going up expands the total market size for store of value assets outside the fiat system.
It raises the floor.
Exactly. It raises the floor for what Bitcoin can eventually capture. Because Bitcoin, arguably, has superior monetary properties to gold. It's easier to verify, instantly transportable, perfectly scarce with a known supply cap, harder to confiscate.
So gold paves the way.
Gold's rally educates the market about the need for an alternative. It makes people more receptive to the idea of non-sovereign stores of value. And once they grasp that, the argument goes, they'll eventually realize Bitcoin is the technologically superior version for the digital age.
So the paradox kind of resolves itself. Stablecoin issuers are forced by U.S. debt, but they use the profits from managing that system to buy gold, preparing for the potential failure of that same system.
Hedging their bets big time.
Okay, that pivot from propping up the old system to hedging against it leads us into the really long-term game theory here.
This is the part that a lot of critics, even smart ones who are maybe skeptical of Bitcoin, seem to miss. They see stablecoins only as this temporary fix for U.S. debt.
But the argument is they're more than that. They're not the final destination.
Exactly. They're the Trojan horse. Highly effective, necessary, but ultimately a vehicle to get somewhere else.
And how do they act like a Trojan horse? What system are they sneaking past?
They completely bypass the old financial plumbing. Think about it. Stablecoins cut out the commercial banks, they cut out the central banks in the transaction flow, they connect users and the ultimate source of funding government debt almost directly.
It's like a new parallel banking system built on crypto rails.
It is. But the current U.S. regulations, that Genius Act framework we talked about, it's desperately trying to protect the old system, the traditional banks. Two main ways. First, mandating that U.S.-based issuers mainly hold short-term government debt. Second, and this is critical, forbidding them from paying interest or yield directly to the stablecoin holders.
Why forbid interest?
To stop them from directly competing with bank savings accounts. If your stablecoin paid you 5% interest and was just as safe, why keep money in a bank paying almost nothing?
Okay. Protecting the bank's deposit base.
Exactly. But that very restriction, designed to protect the U.S. banking system,
Creates an opportunity elsewhere.
Precisely. It guarantees the emergence of a competitive offshore stablecoin market. Issuers based outside the U.S. won't be bound by those rules.
So they can pay interest. And they can back their stablecoins with whatever they want.
Correct. They'll be free to offer yield to attract users, and they can choose their reserve assets, maybe non-U.S. debt, maybe commodities, maybe other things. This creates a true free market competition happening outside U.S. regulatory walls.
In a free market for money, what's the main point of competition?
Yield. It's going to come down to who can offer the best, most sustainable interest rate to attract capital.
And where does the best yield ultimately come from?
It comes from the quality and performance of the assets backing the stablecoin, the reserves.
Okay. I think I see where this is going.
Yeah.
If you want to offer the highest, safest yield,
You need the reserve asset that's likely to appreciate the most over time, with the lowest risk of being debased or confiscated. What asset fits that bill better than U.S. Treasuries facing inflation and potential revaluation?
Bitcoin.
Bitcoin. It's the logical endpoint for a competitive reserve asset in a free market.
We're already seeing the beginning of this, aren't we, with Tether?
We are. Tether already holds about 5% of its reserves in Bitcoin. Right now, since there isn't huge competitive pressure forcing them to pay out yield, they basically get to keep the profits from Bitcoin's appreciation for themselves.
Which makes them incredibly profitable.
Hugely profitable.
Yeah.
But what happens when those offshore competitors start offering, say, 8% yield backed by a mix, including Bitcoin?
Tether has to compete or lose customers.
They'll be forced by the market to increase their own Bitcoin allocation to generate the returns needed to match or beat the competition's yield.
So it becomes a race to acquire the best performing reserve asset.
Exactly. That initial 5% Bitcoin allocation Tether holds, competitive pressure could easily push that to 20%, 30%, maybe even 50% over time. Not just from new purchases, but also because the Bitcoin they already hold is appreciating faster than their treasuries.
The reserve quality just keeps getting better, driven by market competition.
It's a positive feedback loop. Stablecoins put the world on crypto infrastructure.
And then competition on that infrastructure forces issuers to adopt the best crypto asset, Bitcoin, as their core reserve.
And what does this guaranteed, massive, multi-billion-dollar buy pressure from stablecoin issuers do to the price of Bitcoin?
You're going to jack it up, as the source said, dramatically.
It has to. This steady institutional level demand forces Bitcoin towards a much larger market capitalization, multi-trillions. That makes it less volatile, more mature, more suitable as a global reserve asset.
And at that point,
everyone, individuals, companies, maybe even nations, starts asking the obvious question. Wait, Bitcoin is now huge, relatively stable, and it's the actual reserve asset backing these stablecoins. Why are we bothering with the stablecoin derivative? Why not just use Bitcoin directly?
the Trojan horse has delivered its payload.
The stablecoin becomes less necessary once it's done its job. Onboarding the world onto crypto rails and forcing major players to accumulate Bitcoin as the premier reserve asset, the very debt mechanism the U.S. is using and Russia is warning about, ends up being the catalyst that accelerates global Bitcoin adoption beyond the point of return. Tag conclusion and final thought.
Wow. Okay, so that brings us full circle, doesn't it, this whole journey?
It's quite a ride. Stablecoins seem like they're buying government's time, absolutely. A temporary fix for the debt mess. But they don't change the underlying physics of sound money.
Right. We've seen how they act as this booster shot for U.S. debt demand, but at the cost of huge risks, private corporate control, the potential for a wealth transfer like 1933 through revaluation.
Governments are basically kicking the can down the road, hoping they can manage the landing when the reset eventually comes.
But the core idea, the final score, as you put it earlier,
it remains the same. The free market, over time, always pushes reserves towards the hardest, most debasement-proof asset available.
The U.S. can mandate treasury purchases via regulation. Russia can complain about geopolitics.
But ultimately, Bitcoin is positioned to be the asset that settles the score. Why? Because it's the only potential global reserve asset that no state can arbitrarily print, confiscate, or debase.
And the market seems to be recognizing this underlying strength already, doesn't it? That recent whale dump.
Yeah, that was significant. Sources pointed out whales sold over $12 billion in Bitcoin recently, one of the biggest sell-offs since 2022. And
on its price, it held firm, way above key support levels.
That's incredible resilience. Absorbing that much selling pressure without collapsing, it shows a depth and maturity in the market that wasn't there a few years ago. When gold surges, it signals the dollar system is fraying. When Bitcoin eats $12 billion and sells and shrugs, it signals the transition to a new system is well underway.
The monetary shift is happening now. The rails are being built, ironically fueled by the old system's debt problems and the game theory of yield.
It's unfolding right in front of us.
Okay, so let's leave our listeners with this final provocative thought to chew on. We see stablecoins speeding up global crypto adoption while forcing everyone to confront the dollar system's breakdown. What big surprise might hit us first? Will we see a sovereign nation go rogue, embrace an offshore stablecoin model, maybe paying high yield backed heavily by Bitcoin to attract capital away from the traditional system? Or will a major central bank, realizing Tether and others are already front-running them on hard reserves, break ranks and openly announce they're buying Bitcoin for their own balance sheet to compete? Which shoe drops first?